Welcome to the show. I'm Daniel Carter, a macroeconomic analyst focused on global financial systems. Today, we're tackling a question that sounds simple, but is anything but. Who controls the price of gold? And more importantly, why does gold continue to rise sharply with only brief and shallow declines? Joining me is Dr. Emily Rhodes, economic historian and researcher in monetary systems. Emily, welcome.
Thank you, Daniel. It's a pleasure to be here.
Before we dive into markets and price charts, I want to start at the foundation. Gold is, technically speaking, just a metal. Why did humanity elevate it to such extraordinary importance?
Because gold combines rare physical properties with psychological trust built over thousands of years. First, it is scarce. We cannot manufacture it in meaningful quantities. Second, it doesn't corrode or decay, meaning it preserves itself over centuries. Third, it's divisible and portable, making it practical as a store of value. But the most important factor is collective belief. Across civilizations, from ancient Egypt to Rome to modern economies, gold accumulated trust, and in economics, value ultimately rests on trust.
So gold's power is not just chemical, it's historical and psychological.
Exactly. Gold became a universal language of value, long before modern banking existed.
When did gold move from jewelry and symbolism to the backbone of the global financial system?
In the 19th century, many major economies adopted what's known as the gold standard. Currencies were directly convertible into a fixed amount of gold. This created monetary discipline because governments couldn't print money freely. Then came the Bretton Woods Agreement in 1944. Under this system, the US dollar was pegged to gold at $35 per ounce, and other global currencies were pegged to the dollar. In 1971, the United States ended dollar convertibility into gold. That marked the end of gold as the anchor of the monetary system, but not the end of its importance.
And from that moment, gold became a freely traded global asset.
Precisely. Its price was no longer fixed. It became subject to global supply and demand.
Let's address the core question. Who controls gold prices today?
No single person or institution controls it. Gold prices are formed in global trading centers, such as the London Bullion Association and the Futures Exchange, COMEX, in New York. The price is determined by continuous interaction between buyers and sellers worldwide. Several forces influence this interaction: mining production, supply, investment demand, jewelry demand, central bank purchases, speculative futures contracts.
Let's ground this discussion in hard data. What are the recent figures telling us?
According to reports from the World Gold Council, global gold demand has exceeded 4,800 metric tons in recent peak years. Central banks purchased over 1,000 tons in a single year, the highest level in decades. Mine production grows slowly, typically around 1 to 2% annually. That imbalance matters. When demand accelerates faster than supply, upward price pressure becomes structurally embedded.
So this isn't purely speculative enthusiasm. It's backed by measurable supply constraints?
Exactly.
Gold has experienced strong upward momentum in recent years. Why does it rarely collapse in a sustained way?
Because the macroeconomic environment continues to support it. Let's break it down clearly. Number one, inflation. When prices rise across the economy, investors look for assets that preserve purchasing power. Historically, gold has served that role. Number two, real interest rates. When interest rates, adjusted for inflation, are low or negative, holding gold becomes more attractive compared to bonds. Number three, geopolitical tension. Wars, sanctions, and political instability increase demand for safe haven assets. Number four, central bank diversification. Many central banks are reducing reliance on the US dollar and increasing gold reserves. As long as these structural drivers remain, gold's long-term trajectory tends to remain upward, even if short-term corrections occur.
Let me challenge you. Isn't gold sometimes just a fear-driven bubble? Aren't investors overreacting to uncertainty?
Fear absolutely plays a role. Markets are human systems. But if this were purely emotional, we wouldn't see systematic accumulation by institutions like the International Monetary Fund or the Federal Reserve. These institutions operate on long-term risk management strategies, not panic.
So you're arguing the rally is structural, not irrational.
Yes, global debt levels are historically high. Monetary expansion over the past decade has been unprecedented. Trust in fiat currencies fluctuates. Gold acts as a neutral reserve asset in this environment.
Final question. Is gold just reacting to the economy, or does it influence it?
Both. When gold rises sharply, policymakers interpret it as a signal, often a sign of rising uncertainty or declining confidence in currencies. It functions like a financial barometer. Governments monitor it closely because it reflects global sentiment about stability. And since central banks hold substantial gold reserves, its price directly affects national balance sheets.
So perhaps gold's enduring power isn't in its metallic form, but in what it represents: trust, fear, discipline, and memory.
Exactly. Gold is not merely a commodity, it is a historical mirror of global confidence.
Before we close, Emily, I'd like to push this one step further. If gold is a mirror of global confidence, what does its persistent strength tell us about the world right now?
It tells us something subtle but important. We are living in an era of structural uncertainty. Global debt levels are elevated, monetary expansion over the last decade has reshaped financial systems. Geopolitical fragmentation is increasing. In that environment, investors and even governments seek neutrality. Gold provides that neutrality. It doesn't belong to any political bloc. It carries no counterparty risk. It is not someone else's liability.
So when gold rises sharply and holds its ground, it's not necessarily a sign of economic collapse, but maybe a sign of caution.
Exactly. Gold thrives not only in crisis, but in doubt. And doubt has become a permanent feature of modern finance.
Let's talk briefly about the future. If current macroeconomic conditions persist, moderate inflation, periodic geopolitical shocks, large fiscal deficits, what does that imply?
It suggests that gold may continue to play a central role in portfolio diversification and central bank reserves. That doesn't mean uninterrupted vertical growth. Markets never move in straight lines. There will be corrections, there will be volatility, but as long as real interest rates remain constrained and global uncertainty persists, the structural floor under gold appears stronger than in previous decades.
So the real story isn't just price momentum, it's strategic positioning.
Precisely. Central banks accumulating gold are not chasing short-term profit. They're hedging systemic risk. And when institutions think in decades rather than months, that tells you something about how they view the future.
Let me try to summarize our entire discussion in one idea. Gold is not controlled by a hidden authority. It is shaped by supply and demand across global markets. It rises when inflation erodes trust in currency. It strengthens when geopolitical stress increases, and it persists because humanity continues to trust it. Would that be fair?
That's very fair.
Then perhaps the most accurate answer to our opening question, who controls gold, is this: no one controls gold. Gold reflects us. It reflects our fear, our confidence, our fiscal discipline, or lack thereof. It reflects the stability of our institutions. And in many ways, it reflects the health of the global financial order.
And that is why, thousands of years after it first captured human imagination, it still commands global attention.
Thank you, Dr. Emily Rhodes, for this deeply insightful conversation. And thank you to our listeners for joining us in exploring one of the oldest and most relevant questions in economics. Until next time, this is Daniel Carter reminding you, markets move on numbers, but value moves on trust.